Welcome back to Money Growth Project. I've got a cool video I think you guys are going to like today. We're going to be talking about mortgages today. So guys,
I think that's exciting.
It is. Amber, say hi to everybody.
Hi, I'm sorry. I went in a little bit early, didn't I? Hi, I'm Amber Coleman.
So guys, Amber is a loan officer here in Las Vegas in Nevada where I live. But we're going to be talking about stuff today when it comes to mortgages and the whole process of it, regardless of what state you live in, okay? So her team does operate in numerous states out west here in the United States, but, a lot of the stuff we're gonna be talking about is gonna be more specific, to your area. You wanna keep in mind, it's gonna be more specific to your area. So she's been in this business for almost 20 years. You're in year number 19.
You're aging me right now.
I'm gonna tell them how many years you've been doing it.
Okay, yeah.
All right, so she's in year number 19 of doing this, okay? Last year in 2020, a year of chaos, her team had over 500 mortgages and over $150 million.
It was a crazy year.
Yeah, so she's been doing this for a while. She knows what she's doing. But we're going to be talking about mortgages and that kind of thing today. And your team, just so everybody knows, you guys operate in how many states?
We operate in 6 states right now, my whole team.
And those are?
Those are California, Arizona, Nevada, Utah, Idaho. Oh no, it's 5 states.
Okay, 5 states. All right. But either way, 5 states.
We're working on our 6th, so that's why I was thinking 6.
There'll be contact info, social media, all that kind of stuff for Amber down below. You guys can follow her, okay, if you guys want to get in touch with her after this. But we're going to do a lot of good information for you guys today about getting a mortgage and about that process and that kind of thing. So, let's start with the first thing. So someone who's watching this who is new to this and they're, looking at they need a mortgage lender. Maybe their realtor has someone they recommend or something like that. But, what would you tell someone, regardless of what state they're in, how to choose a mortgage lender?
So, well, right now when you're choosing a mortgage lender, it's really important because when you go out looking for houses, no matter where you live, it's crazy out there right now. Like you're having to fight multiple offers. It's just the craziest market ever. So right now you need somebody that really knows what they're doing. Like you don't want to be somebody's guinea pig. There's some new people that are coming into the business and it's hard to be somebody's guinea pig. Secondly, you need to have somebody that knows your market. So like if you're buying a house in Nevada, you need to be able to have a loan officer that knows that market and that works in that market consistently because you're going to have the appraisal connections, just the stuff that you need like on the ground. You got to be able to have that together. And you also want somebody that knows, like you want a good name in the industry. So you want to be able to work with a company that has really good, just really a good name in the industry that knows what they're doing, that's been there for a while. You don't want to be in the middle of a transaction and find out they can't fund your loan on something. That would be a really bad thing, right?
Yeah, you recommend generally not going to some huge bank or something like that.
The huge banks are harder. And I'm not just saying this because I kind of, I stay with a bigger bank, but not too big. So when you're talking about banks that fund loans and they do bank accounts, like, deposits and stuff like that, their primary goal isn't to fund your loan because they make their money other places. So a lot of times when you're going through like a bigger bank like that, you're going to close late. And in this market, that can mean your deal. So, you have to be careful to make sure that it's somebody that can also move fast to hit all the dates that you have and answer their telephone. Does that all make sense?
Yes. I mean, someone a little smaller gets you more personalized attention.
Yeah. It's important to have some personalized attention right now.
Exactly. So let's also jump into talking about, bank versus mortgage company versus mortgage broker. I mean, those three. I mean, what are your thoughts on each one, or what would you recommend is the best route to go?
Well, so bank versus mortgage broker versus bank. So the bank is harder because like I just said, you're dealing with them the mortgage is not being their top priority. So you're dealing with late closings. You can't get a hold of anybody. There's a lot of frustration. Sometimes if you're on the other side of the loans, like the real estate agents, they're like, I can't do this anymore, and you might not get your offer accepted because they've already had frustrations with a big bank.
Right.
So I'd stay away from a big bank. Mortgage broker, like I'll do both. I brokered loans and then but I mostly will use my own bank line within Guild Mortgage to be able to get those loans done. I try to stay away from broker a little bit because, again, you don't have the personalized attention and you don't have the control to be able to get it done in the time frame possible. So I would prefer like banker on the banker side.
Okay, cool. So let's jump into that topic of refinancing. a home loan, because that's been going on a lot the last year or so.
Yes, it
Some people
has.
refinancing like even multiple times in a year with their home.
Yeah.
So, when someone who's new to refinancing, what tips, what advice do you have that you give to someone who's new to refinancing?
Okay, so if you're new to refinancing, kind of know your plan, because to refinance multiple times costs you some money, and even though you don't pay it, it's on the
Mhm.
the cost of your house. So kind of know your plan. And here's what I look for in refinancing. It's always number one is rate, right? You want to make sure you're saving rate. So if you're going to pay those costs, make sure that you're saving as much money as possible. But sometimes what people overlook too is that you can really gain a lot by cash out refinancing, and that's what a lot of people are looking at right now. Like with all that's happened, sometimes people have accrued debt, but thankfully within COVID, they've accrued a lot of equity in their houses too. So sometimes you can look at that equity and say, hey, maybe I can better my situation by taking out money out of my house to lower my overall debt. And since right now rates are still really low, they're starting to tick up a little bit, but we're still in COVID rates, which means they're lower than they were before COVID even started.
Right.
So like if you have if you've accrued some debt because maybe you've been out of work a little bit, but you have that equity in your house, you can cash out, refinance, pay off that debt, and lower your overall expenses. So I think right now that's what a lot of people are looking at doing. Obviously rate too. Sometimes people are looking at paying their houses off early, which I'm always a big, a cheerleader for. So then moving from a 30-year fix to a 15-year fix while the rates are so low is a good idea too. Just kind of depends on what your personal preference is.
So, how do you think this stimulus package, this $1.9 trillion, how do you think this is going to impact, the mortgage industry, home prices, people looking to get loans, right? Anybody in your industry or in your professional world?
Yeah. Honestly, I'm going to be straight honest here. It scares me a little bit. I'm going to be straight up honest right now. So the reason why the stimulus scares me a little bit is because of inflation. So whenever there's a lot of money pumped into the economy, then there's always an inflation problem. We're kind of seeing it right now where the price of everything's a little bit more expensive. So our dollar's not going further. And inflation is always kind of the enemy to interest rates. So as inflation takes over, or inflation becomes more of a problem, interest rates have to go up to
offset it.
So there's always a give and a take. Nothing really ever comes for free, right? So I'm looking at that huge amount of money and I'm like, ooh, I think the cost of that's going to be kind of expensive in a lot of different ways. So the interest rates is what it kind of makes me nervous because of the inflation factor.
But if you're already a home owner and you already have your home and you're going to see this inflation, what do you think? What do you think about people who currently already have homes, or they're able to get a home before the inflation gets bad?
Well, I mean, if you're able to get a home before it gets bad, then you're in a great place. Try to get your home right now, I would say, or in the next year or so before it's something. And I don't want to really say something will get bad. I don't know, but I just know the inflation is ticking up, and every time I watch, I try to keep an eye on what the economists are saying, and the fear right now is definitely on inflation. So if you're already a homeowner, you're in a good place, especially if you've already refinanced and you have your, low rates. We're still going to be paying it somewhere though. We're going to be paying in all aspects of our lives right now. So if you're going to want to move to a bigger house at some point, it's probably going to be a lot more expensive.
Right, because lately we've seen is inflation in people's assets, like people who own stocks, people who already own real estate, and that kind of thing. So I mean, those people, you see your.
Well, the other thing too is if you're looking at inflation, and if inflation is always in the past, unless something changes in the future, cause rates to go up, then when rates go up, your home value usually goes down, right? Like people can only afford so much, so it's usually a give and take right there too. So the value of your house might be a little bit less if we look at higher rates than it would be with lower rates. Does that make sense?
Yeah. So I mean, but let's talk like the interest rates. So, they've started to go back up a little bit. But I mean, if you had to make any kind of prediction for throughout this year, I mean, what do you think people will see when it comes to mortgage interest rates in 2021? I mean, what would you expect? Them to stay where they're at, gradually creep up?
No, I think we've already kind of seen them gradually creep up. So what's happening in 2021 is it's definitely had a bump. When COVID was at its height, the rates were, I never thought they could even get that low. That's how crazy low they were. And then as the numbers of COVID cases and deaths started going down, the rates creeped up slow, like not even slowly. Some months it was pretty fast. I think I saw a 0.5% overnight one day. So
Jeez.
it was pretty fast, but they dropped so much, there's still room. So in 2021, I'm kind of feeling like they're going to be good. We're still going to see good rates, but eventually we're going to be back to rates that are pre-COVID.
Right.
And what I'm being told to kind of look at is once inflation hits 2% and unemployment hits like 4 to 5%, then the feds, who've been artificially keeping the rates lower, because the rates are low right now because the feds are feeding so much money into the mortgage-backed securities. And so that's kind of artificially keeping our rates lower. Once the inflation hits 2% and unemployment hits 4 to 5%, then that's when they're talking about pulling back what they're putting into it. So then we could be looking a little bit worse when that happens. Because I think they're keeping the rates about 0.5% lower than what they really should be. So we'll start going up once all the cities start to open.
Okay.
Does that make sense?
Yeah, no, it does. But that's, so it's, we'll see what happens throughout 2021. But like you're saying, it's going to be it's already gradually going up, but that seems like that trajectory is probably going to continue.
Yeah. Usually good news means higher rates. Bad news means lower rates. So we don't want to wish for bad news. We saw what that did last year, right?
Simple way to think of it.
Yeah, so right now, as the cities open and people are going back to work, you're going to be seeing rates creep up because people are back to work.
Yeah.
So we are going to be looking at higher rates. I don't think there's many ways to avoid that.
Well, and speaking of homeowners and how a lot of this, can impact homeowners, let's talk about paying off the home early and this idea of, keeping your mortgage, not paying it off early, right? Just paying it off when you're supposed to and, having that money to go put somewhere else versus the idea of paying it off early and just, having your home owned free and clear. What do you support and why?
Okay, so I think that's a personal that's a personal thing.
Right.
But here's what I support, and I'm going to tell you why. So I went through the downturn of the economy, like where, when home prices just plummeted, and I'm in the mortgage world, so my income plummeted right with it, and I lost everything. I lost 2 houses, I lost a car, I even lost my driver's license, probably because of the stress and my medical condition. And so with all that, I had to rent. And when I went to rent, it sucked. I think I was blessed with like the worst landlord anybody could have. And I couldn't handle not owning my own life, like not being able to paint a wall whatever I wanted, right? Like renting sucks. Don't you agree? Like it's not fun to be feel like your life is owned by somebody else. Maybe I just got spoiled or something with it. I don't know. But
sounds like you had a pretty bad.
I had a really bad landlord. She was threatening to sell every other day. It was ridiculous. Sending people in to check the house to make sure there was no mess. I'm like, this is crazy. But anyway, I won't go into her. But when that happened, I was like, I want to be able to own my own life. So I ended up being able to buy a house as quickly as I could. And honestly, I didn't even really care what I paid for it at that point because I looked at a house completely different than I did before. I looked at a house like it was my home. Like no matter if I own or if I rent, I have to have a roof over my head. So I need to be able to make that place my home and to know that if I can't be kicked out of this place if I don't want to be kicked out of it. So I looked at it differently. And when I got into it, I still feared, when you lose everything or when anything bad happens to you, it leaves you with a sense of fear. So I still feared losing it again. I didn't want to lose my house. So at that point, I had to change my mindset and not worry about a 30-year fix to where I could like pay it off when I retire, or whatever. Right. I took every extra money that I had, kind of did like, what people would now consider the Dave Ramsey approach, like snowballing it.
The debt snowball.
Yeah, the debt snowball. And I ended up, working so hard. So I went from bankruptcy to like paying my house off within 9 years. So my opinion of what we should do is I would rather pay off my house and then take all my money and put it into all the investments because then I have security and then I can then plan for the future. Right. Some people would prefer to just pay as low as possible and then put it into like the rest into investments. But because of I think what I went through personally, I would rather have the security.
Yeah, you basically rather have that emotional stress or that mental
Yeah.
stress is off your mind, okay, then you know that part of your life you don't have to really think about much anymore.
Yeah.
And then you can do other things.
And I feel like it caused me to be able to use my energy in so much different ways, which, whenever energy is put out there in good ways, sometimes money just flows. So you can put it into investment properties or investments of all kinds.
Yeah. So let's talk about ways for parents to build wealth while their kids are going to college. This is something that probably not too many people know about, but you shared this with me before, and it was a great idea to help not just offset the cost of college, but also have something that makes you money long term. It can be part of your retirement plan. So tell me about this plan that you've done yourself, actually.
I love this plan. I'm going to tell you about two plans, because there's this plan and there's another one,
all right,
okay?
go
Because
for
they're
it.
both exciting. But so when your kids are going to college, I mean, it's expensive, right? And then you pay for housing, and housing is like it's expensive to send your kids to college. So I was just trying to figure out, okay, how do I do this and do it smart so that I can at least be gaining something when my kids are at school? And then I found this beautiful loan program that's out there. So if your kid, they have to be in a different state, and they kind of changed this around lately, but they have to be in a different state. So say you live in California and your kids are going to school in Nevada. That's totally fine. They can't be within 100 miles from you, but you can buy a house. You don't have to pay investment rates on it because your kids are going to live there. That's my favorite part, okay? So it's like primary residence interest rates. You have to put down 10% on it, so you have to put some investment into it. And then while your kids are going to school, they have a place to live, but you're building equity on that. And my favorite part is they're living in one room, and you have their other college friends in all your other rooms, and they can pay you rent so that your house payment is being paid to you. You don't have to pay for housing while your kids are going to school, but you're probably making a profit on it because you can rent those rooms for a decent amount.
Yeah.
So yeah, it's just a way of kind of making money while your kids are there and not having to spend $1 million on housing expenses for them.
Exactly. So you're getting the monthly cash flow. Your kids got a place to stay for free. So, and then like you said, you're building equity, and it could be something that's a long-term part of your retirement portfolio.
Yeah. I mean, because you can keep that house long after they live or long after they leave there, or, sell it when they leave. And right now, the way equities are moving up, I don't know that there's a loss in that, but as long as it continues like that. The other one that's kind of exciting, that's kind of similar to that, but this is for your parents. So if you have a parent that, they can't afford housing, maybe they're retired right now, maybe something happened, you can also do the same thing for your parents, but you don't have to be in a different state. And that one, you only have to put 5% down. So basically, because your parents are going to live in the house, you can buy the house for them, acknowledging on the loan that your parents are going to live there, and acknowledging that they're retired or whatever, but you don't really have to provide paperwork for that. You're just acknowledging that your parents are going to live there. You really truly want to have your parents live in the house and have your utilities in their name or your name, because it will be checked up on. But it's only 5% down. It gives you the ability to have another property to gain equity on something else while still helping your parents. I think that's a pretty cool program too. Did you like that one?
I do. I didn't even know about that one. Can that be within the same state you live, or is that
that could be in the same state that you live in.
So there's no geographic restriction on how close, how far, anything like that?
That one doesn't. The kid one, they did change that one to where it does have to be kind of like a second home, like at least 100 miles away from where your primary residence is.
Jeez, okay. Well, let's talk about, so for another demographic, another niche here, let's talk about VA loans, because these can change a little bit, from year to year and that kind of thing. And you grew up in a military family, and you've helped many veterans get VA loans. So let's talk about VA loans for this year, 2021, and what people need to know if they're looking to get a VA loan.
Okay, so VA loans for 2021. I mean, really, VA loans, there's no better loan out there than VA. Like, it's the best interest rate. It's the best loan program, like, altogether. You don't have to put any money down. If you're disabled through the military, you get to waive the funding fee that's on the VA loan. And a lot of times, some people don't realize this too, is that you get tax breaks on your property taxes depending on what county you live in. But I think a lot of counties do give breaks on the property taxes if you're a disabled veteran. So definitely take advantage of that. There's also a program out there, and this is specific to certain counties, so you have to check the county that you're living in, that's a loan for heroes. So on this one, it's kind of like a grant loan, but the grant is used to pay to buy down your interest rate. So if you're under a certain income, then you can get a lower interest rate by using the VA loan, and it's called the Heroes Loan. In most places, like, you have to kind of check your county restrictions on that, but you can get a lower than going rate with this program. So it's a pretty awesome program.
Okay, but I mean, aside from some of those like maybe local things about, like you said, tax breaks for whatever level of disability you may have or other programs, I mean, the process for a VA loan is fairly straightforward regardless of which state you live in.
It's very straightforward, and they have a lot of more lenient guidelines in certain cases than the other loan programs do. And they do offer exceptions for veterans. So if you're a veteran, there's something that's holding you back, it's better to just check on it and see if it's something that you can get an exception on.
Okay. And have you seen with the VA loans, it being traditionally faster than a traditional loan, or does it totally depend on?
It's about the same.
Okay.
The process for a VA loan is about the same as any other loan. The only thing that's a little bit slower is the appraisal.
Okay.
So the appraisal, VA requires that we give them 14 calendar days, 10 business days to be able to get an appraisal back. So a lot of times on VA loans, you need to ask for about 30-day closing.
Okay. And then, with VA loans, what would you say is, if there is one roadblock or one hurdle that comes up the most, whether it's, on the side of the veteran or in the process in the system that, or something people just don't expect, that seems to be the most frequent you've seen?
So VA has something that some people don't expect on VAs is they're not expecting the funding fee, because that's an additional cost that's added onto your loan. You're not paying it out of pocket, but there's still a fee that gets added to your loan, so it brings up your cost of your house a little bit. Sometimes if you've had like past issues with VA, so most people are forgiving, like you always hear, well, if it's after 7 years or 10 years and it doesn't show on credit anymore, VA never forgets. So if you had like a past short sale or foreclosure that may be 20 years old, it'll come up on a VA. So that's something that might catch you off guard, is you'll be like, I didn't even remember that I had that on a VA loan. But there is a tier 2 way that you can do those too. So then we just have to kind of reach out and see how they're going to make us do it, depending on what kind of loss the VA had to take. So they don't forget when you mess them up. Like if you ran into a hard time at some point, VA will keep records forever. So,
but I mean, it's nothing that you can't overcome.
No, you can overcome it. That's the thing. They give you ways, but sometimes it's not like if you had something like that, they might make you put a small down payment down, or depending on the losses that they took. So they give you ways to be able to still do it. They're a very forgiving and honestly great loan program. It's an amazing loan program that they offer to the veterans.
Okay, cool. Now, let's also talk about if somebody wants to get a mortgage for an Airbnb property. Now, I know when it comes to Airbnb, rules can be very different from state to county to city, especially where we live here in Las Vegas, where so much of our economy here depends on travel, tourism, and that kind of thing. So, obviously lots of the local laws can vary a lot. But I mean, if you had to talk about, give some advice to someone looking to get a mortgage just for an Airbnb property, what would you tell them?
Well, first I'd ask the questions. Okay, so on this property, are you getting it just to Airbnb? So is it going to be Airbnb the whole time you have it, or are you getting it to use for your property sometimes, and then when you're not there, then are you going to Airbnb it? So like it's a different in low programs depending. So if it's a house that you're going to use, let's say, part of the time, let's say a couple weeks or 3 or 4 weeks at a time, and the utilities are going to be held in your name, but you're going to Airbnb it, then because you're going to be living in that property when you come to vacation here, then it would be considered a vacation property. So that's a different loan program. Okay. But if you're going to use it straight for investment property and you're going to, rent it out all the time and never going to be in it, then that's an investment property that you'd be doing you would be doing on the Airbnb. So it would be a matter of digging into, what the situation is with the person that's going to buy the house. And then,
but within that, I mean, how often do you need to be there for it to be considered vacation versus purely investment? I mean, is there any kind of guideline, or is that also just state to
for
state?
A vacation property, I believe it's 4 weeks that you have to be in the property out of a year.
That's it?
To be in a vacation, yeah.
Oh, geez. Because, because here, especially here in Nevada, we get a lot of people from like the Midwest who are here part of the year and they're somewhere else part of the year and that kind of thing. So, I mean, so generally it's only about 4 weeks of the year.
So like even if it's a primary residence, you'd have to be there 51% of the time.
Right.
So and you'd have to be able to show that you're there 51% of the time. But second home,
Mhm.
you know, it's more used for vacation and that kind of stuff. So yeah,
So, I mean,
that was a good question.
So it wouldn't be uncommon. I mean, if you had the money, you could have, I mean, your primary residence, you could have 2 or 3 vacation homes that you could visit throughout. I mean, you only got to be there about 4 weeks a year.
Mm-hmm.
So, I mean, if logistically you can manage, you could have multiple vacation homes,
Yeah.
and you would not have to pay investor interest rates
Yeah.
on them as
The
Airbnb.
only thing is a lot of times on the Airbnb, it's hard to qualify with the income that you make off of it until you've had it for a while. So, you know, you'd have to make sure you make enough income. Like when you're buying an investment property to rent out,
Right.
you can use the rents that's going in that area to be able to offset your debt ratios.
Oh, but not with Airbnb.
But not with an Airbnb. So you have to make sure that you make the income to qualify for where you're living right now and the new house too.
Jeez, that's pretty good.
Mm-hmm.
Well, I mean, we rolled through these questions pretty quickly. So a lot quicker than I thought it was going to go. So, I mean, hey, thanks for coming and sitting down.
Oh, no, thanks for having me.
You
It's
know.
always good to be on your channel.
And then again, guys, links for all Amber stuff is going to be down below in the description. So if you're in one of the 5 states she operates in, so California, Arizona, Nevada, Utah, Idaho, you can contact her team. Or if you're in another state, she can refer you to someone else if you guys need help with a mortgage. Or if you guys just want to follow her channel, she gives all kinds of great advice, all kinds of tips on there. But I wanted to bring her on here to help you guys today. So Amber, thanks again for coming on.
Thank you for having me. I appreciate it.
So I appreciate you guys watching. Appreciate you guys hanging out. Thanks for watching this video, and I will see you guys again soon.
Bye.